Rick, let's just start off with, can you explain why good credit is so important when you're qualifying for a mortgage?
Sure, yeah, credit is kind of everything when it comes to a mortgage, and it's really the starting point. So, when we have somebody complete a loan application, the next step is to run their credit. And good credit will get you all of the loan options, the best rates, and the lowest fees, whereas not so good credit, can lead to higher rates, higher fees, and maybe not even being able to be qualified.
Can I just go online and get my own credit scores? Is that going to be the same thing?
Not quite. So when you go to I think Credit Karma is a big one, or MyFICO, any of those credit scores, their scores are going to be a lot different than a mortgage credit score.
Okay.
So, and generally they're going to be higher. So you want to know what your mortgage scores are, because you could have a certain Credit Karma score and think, hey, I'm in good shape. But then a mortgage model is generally more stringent when we run credit. Now, every mortgage company is going to have the same model, but any mortgage person you talk to would have the same score, but it's going to be different than if you go to Credit Karma, if you go buy an auto loan, or if you apply for a credit card. They're all different models, and the mortgage model tends to be the more stringent or show lower scores typically. The biggest thing is if you're thinking about buying or refinancing, or even if it's 6 months down the line, you really want to know where you stand. So you want to talk with a mortgage professional, go over your situation, and then ask them to run your credit. A lot of times people will say, well, I want to wait, I don't want to hit to my credit score, but that can do more harm than good. 6 months down the line, the hit we look at won't even affect your score, but more importantly, you're going to know where you stand. And you're also going to know, what can I do between now and then to get my score to that next realm of a better credit score, to get a better rate or a better program. If you're getting a lot of credit inquiries, you're applying for a lot of credit, then that can hurt your scores. The models kind of look at it like, hey, this person's maybe a little desperate to get some credit, too many inquiries. High balances on credit cards, so generally you want to keep your balances below 40% of the max limit. So people may not really understand this. There may be some collections out there that you weren't aware of. A lot of times medical collections, which you don't really need to pay off to get a mortgage, but they can definitely affect your score. So if you're looking at all these things 6 months in advance, we can advise you on things to do. Maybe take care of a collection, or pay down some credit cards to get the ratios better, see your scores move up over 6 months.
How will the credit scores themselves, how do they specifically impact the mortgage process and also loan options?
Yeah, so kind of look at credit scores in ranges of 20 points. So typically if you're above 700, that's going to be good, and you're going to be able to look at an FHA or a conventional, all types of loan programs. Whereas if you're below 700, and then you get below 680, then you're probably thinking, well, FHA might be a better loan because they're more forgiving of credit scores, right? As you go to a conventional loan, they're more credit score driven. So it kind of goes in realms, like you probably need a bare bottom 620 just to try to get an FHA loan done. And then 640 gets a little better, 660, 680, and then once you get above 700, it's like, well, you're probably in conventional loan territory, which means it's going to be lower costs, lower mortgage insurance if you're not putting 20% down. And then as you go up above 740 to 760 and above, it's kind of all the same. But we could say, hey, what happens if we can get your score from a 695 to a 705? Well, now you have a different loan option, a different down payment option. It opens up your options.
Finally, we're in a very competitive market right now. Does the different type of loan affect my ability to buy a house in a competitive market?
Sure, that's an awesome question, Barry, because it does affect. Because right now in the Phoenix market, being as competitive it is, and then I know we're talking to a lot of people that are moving to Arizona right now. So if you're moving here, you may not be that familiar with the local market, but it's very, very competitive. And a lot of times, sellers, agents, and sellers, they may not want to accept an FHA offer, for example. They're only looking at conventional because they're afraid an FHA appraiser may condition things on the home that a conventional appraiser may not, for example.
Okay.
And then just in general, conventional borrowers may be deemed as more qualified borrowers. And so a seller in this competitive market is looking at the best offer, and also they're going to consider, can this person close on the loan? Are they well qualified? And sometimes they may deem a conventional offer better than an FHA, for example.
Okay.
Best first step is to talk to a mortgage guy like myself.
Okay.
We can go over your situation with a phone call, have you complete a loan application, and run your credit. And then we can determine what are the best steps over the next 3 to 6 months to get your credit scores as high as possible.
Okay, cool. All right, well, thank you, Rick. Those are great points. I appreciate that.
You bet.